Okay, so good morning to you all, professors. Once again, we meet on Omega vacation classes for our discussions on accounting. For the past weeks, we have been looking at the final account of a sole trader, and we have been able to exhaust discussions on the trading and profit or loss account. Today we'll be looking at the third one, which is the balance sheet or the statement of financial position. So the balance sheet, statement of financial position. So before I carry on, professors, is any of us here having an idea as to what this statement is about? If yes, please share with us what your view about the balance sheet or statement of financial position is about. Okay, let me, Prof. Nicole, let's hear you.
So please, the balance sheet helps the business know how much or how many assets, capitals, and liabilities they have in the business.
Okay, thank you very much. Thank you. Any more? I want to believe during your discussions of the accounting equation, this might have popped up somewhere. Prof. Amuzu, do you have any idea on this statement of financial position?
Except this, no.
Okay, that's fine. Prof. Finati.
Please, I think it is a financial report that shows what a business owns and how much the owner has invested in the business.
Okay, thank you. Let me speak to Prof. Mauli Agbenyo finally and continue. Prof. Mauli, have you come across this? Have you read anything around it? Prof. Mauli, can you hear me? Okay. Stacy, let me hear your version as well if you have anything on this.
A balance sheet is like it shows what a company owns versus what a company owns.
Okay, great. So yes, I think you have pieces and bits of what this statement is about, right? Or this balance sheet is about. So yes, it shows how much a business owns, as in OWNS, and how much it owes, OWES. So using the technical term, then you can say this statement shows the assets, the liabilities, and capital of the business. Okay, so what a business owes is the liability, right? And what it owns is the asset. Okay, capital is actually what a business owes, to the owner, right? So when we talk about what the business owes, we are referring to the liabilities and capital, right? Okay, so let me put it down there that this is a statement prepared to show. So it is prepared to show a business assets, capital, and liabilities. Okay, so that is it for a balance sheet. When you look at it, it tells you the financial position, right, of the business. Is the business having enough assets over how much it owes people, or is it the reverse, right? Okay. So then this gives you a clue that in this statement, the element of account that we are interested in will be the assets, the liabilities, and the capital, right? But you also know that the assets are categorized into fixed assets and current assets. Okay. Now the fixed asset could be referred to as non-current assets. Then the liabilities can also be grouped into current liabilities and long-term liabilities. Long-term liabilities can also be referred to as non-current liabilities. And finally, you have the capital. Now, let me add that capital is affected by these two things: net profit or loss and drawings. Okay, and sometimes too, the owner can introduce more capital, so we refer to that as additional capital. Okay, so take note of these things I'm mentioning. Okay, so this is the idea about the balance sheet. Now, how do we prepare it? Its presentation or preparation is, can be in several forms or several presentation methods. You can use the horizontal, the vertical. Even the vertical, we have the total assets method, we have the net asset method, etc. Okay, but I always introduce my professors to the net asset method because that is the modern style of presenting the balance sheet. Now, note it somewhere that this balance sheet is not an account. Unlike the trading account, the profit and loss account, the balance sheet is not an account. It's just a financial statement, okay, showing your asset, liabilities, and capital. So in the balance sheet, there's nothing like debit side, credit side. But for the trading account, we have the debit and the credit. And the profit and loss, we have the debit and credit, right? So for the trading account, you appreciate that the credit side is where the sales, okay, the net sales elements are. And then the debit side is where you have your cost of sales. And then in the profit and loss account, your total income is on your credit side and your total expenses are on the debit side. But in the balance sheet, we don't have debit and credit side. Okay, so you can decide to put any item anywhere, depending on how you want to present it. Okay, so note that. Now let's go straight to the presentation. So it has a title, Balance as at. Okay, as at. Then you add the date to it. Now you would appreciate that the trading account and the profit or loss account, they had a title ending with for the year ended. But balance sheet is as at. There's a reason why. And the reason is that, please note it somewhere. The reason is that the trading and profit and loss account are prepared for just an accounting period, normally 12 months or 1 year. Okay. But the balance sheet, okay, the balance sheet is a presentation of all the asset, liabilities, capital balances from the date the business started doing business to the time you are preparing it. Okay. So for example, if I should use you as an example, if you're a business and you are preparing your trading profit and loss account, it might be for just 1 year, maybe 2025, 2026, 2024. But if it's your balance sheet, then we'll go and consider as far as the date you were born. Okay, so the current date we are preparing. So the balances you see in the balance sheet is a picture of all the asset liabilities you have carried from the date you started business, okay, to the date you are reporting. So in essence, it means that the balance sheet items cover a period more than 1 year, right? So that is why we have the difference in their titles. Okay. Now, after your title, the next thing you show again is your currency columns. Just like the trading account, you have 3 currency columns. Here, let me use the Ghana cedi. Okay. Good. Now, I'm going to give you a skeleton of the balance sheet based on the method I'm going to teach you, and I indicated that this is the net asset method. And the presentation is in the vertical format. We are not using the horizontal. The horizontal is where you try to put it in a T account, right? But we are using the vertical. So pay attention. So for the vertical format, let me give you the skeleton. You begin with your fixed assets. Okay. You begin with your fixed assets. So normally your fixed assets will be at the total will be at the 3rd column. Okay. Then you present your current assets. Okay. Put it at the 2nd column and subtract or less the current liabilities. When you less current liabilities from current assets, professors, you get something called working capital. Working capital. Please note this somewhere. Working capital is the difference between your current asset and current liability. Current asset, current liability. The difference between them is the working capital. So this working capital is now added to your fixed assets. Okay, and that will give you your net total assets. So my professor should appreciate that if you are preparing the balance sheet using this method I'm preaching to you, right? You begin with your fixed asset, as you see here, right? Then after, you go and look for your working capital. Okay, and working capital is simply your current assets minus your current liabilities. That'll give you the first part of the balance sheet. Now, if you appreciated the items we needed to prepare the balance sheet, look at it. The fixed asset has been used, the current asset has been used, the current liabilities have been used. What is left is the long-term liabilities and the capital. Okay. Now, this presentation or this method seeks to help you appreciate how your assets were financed. So if a business says, I have a building, I have stock, I have cash at bank, how did they get these assets? How were they financed? Okay. So the second section of your balance sheet speaks about how these net assets you have determined here were financed. So that begins with the title Financed by. Then we bring in the capital first. Okay. We put the capital here. Then, like I told you, capital is affected by drawings. Okay. If the owner makes investment and then he or she goes to withdraw or takes something from the business for personal use, it is going to affect the capital. Okay, so in the balance sheet, we list all drawings that the owner might have made. We'll list from it. And then the net profits, right? If a business is making profit, it means that the capital will be increasing. So we add net profit. If it is a loss, you would subtract, right? So remember, I spoke about additional capital. So if the owner introduces additional capital, let me add that. You would also add that additional capital. So when you do this adjustment, technically we can say what you have determined is called net capital, or technically closing capital. Closing capital. So the closing capital, you now add on the long-term liabilities. Long-term liabilities. Okay. Then the total, when you add the closing capital to your long-term liabilities, the total you get is called the capital employed. And professors, this capital employed should always be equal to your net assets. The capital employed should always be equal to the net asset, right? So this is the balance sheet. This is the skeleton of the balance sheet. If I say skeleton, it means that I've tried to reduce it, removing some of the items, right? So it is this skeleton we are going to develop into the bigger format, and nothing is going to change there. Just that as I mentioned fixed asset, then we are going to list some of the fixed assets and put them there. List the current assets, list the current liabilities. Okay, but this is how you prepare your balance sheet. If you're able to understand this method, you can manipulate it into other forms, right? But for now, let's concentrate on this presentation method. Any question? Any question, professors? Those who came a bit late, if you missed some points and you want me to, go over, why not? Okay. So if you are learning the balance sheet, this is how I want you to approach it, right? So I will go, hold on, I'll come to you. Your balance sheet is going to show your assets, liabilities, and capital. So technically, let me I think help you appreciate the other forms of presentation. Maybe then it will make sense. So in some presentation, all they do is, right, like I said, they can present it in the T format like this, where they will put the assets at one side, right, and then put the capital and liabilities here. And you know that this balance sheet has its basis from the accounting equation, and we all know the accounting equation: asset is equal to capital plus what? Liabilities. So if you use this presentation, actually, you are demonstrating the accounting equation that your asset on one side should be equal to your capital plus what? Liabilities. And like I said, you can decide to bring the asset here and bring the capital and liabilities here. That it doesn't have any impact, right? Or it doesn't make any difference. Okay. Now, if you look at this method I've demonstrated, somebody can decide to bring this fixed asset, current asset, less current liabilities to one side and then bring the finance by to the other side. It doesn't matter. Okay. In fact, in some presentations, some do the assets, okay, the assets and less the liabilities from here, and then they say it should be equal to what? Capital. Okay, so they just manipulate the accounting equation. It doesn't matter. But let's focus on this method, net assets, the vertical presentation. Okay, Gabriel, you can ask your question now.
Sir, please, can you start this place again? This one, the fixed asset and the current asset, please. I don't understand why the current liability is under the asset place.
Okay, so there is something in determining the financial position of a business which is called liquidity, right? Liquidity. When we say liquidity, it simply means how a business can easily generate cash. Okay, how a business can easily generate cash to settle pressing obligations. If a business has enough cash to settle pressing obligation, when I say pressing obligation, it means that liabilities that are due and needs to be settled. If a business has enough cash to be settling these pressing obligations, then we say the business is highly liquid. The opposite means that the business is running into some liquidity problems, and that is a bad indicator. It means if the business is not careful, it might have to shut down or it will go into bankruptcy. To help appreciate this liquidity, most of the times we compare our current assets to our current liability. Okay, so from the view of this, you can tell that, okay, the business can use their current asset to settle their current liabilities. Because of course, the most pressing obligations will be the current liabilities. So this presentation in a way helps you to appreciate that, okay, the business is in a better liquidity position. That is the rationale for presenting it that way. So you see that long-term liabilities is down here, while current liabilities is up here, being deducted from current assets. Now, if you analyze it carefully, you see that the long-term liabilities, in a way, they are not pressing. Why am I saying they are not pressing? You have a long period to settle. So in a way, it gives you some form of space to do business. That's why normally we add it to the capital. Okay, that's how much the owner has invested plus the long-term liability, because these two gives us enough space to run the business. Or they are, a long-term source of funding to run a business. But current liabilities are not. So normally we compare them or we less them from the current assets to know how the business working capital or liquidity issues may be faring. Okay, so that's why for this net assets, you see that way. In some presentations, the current liabilities may come and add on to the long-term liabilities, right? But I said, this is the modern or the standard way of presenting it because it gives a lot of information. A user can look at the financial information and see that, imagine, let me put in figures. If your current asset is 100 cedis and your current liabilities is somewhere 200. Okay, meaning that your working capital will be negative. It tells the reader that you are not doing well. Even your current assets cannot settle your liabilities. And why are we comparing them? Because both of them are expected to, last for 1 year, right? In the normal course of doing business, your current assets should be converted into cash within 1 year. And your current liability should be settled within 1 year. Okay, so if you have more current liabilities than your current asset, it tells that your business is suffering. If you don't present it this way, and imagine you come and put the current liability somewhere here, you might not be able to fish out this problem. Okay, unlike if it's presented this way. That is why this method is now preferred, and most businesses, show their financial statement this way. Prof. Agweko, I hope you are comfortable now.
Yes, sir.
Okay.
Sir, please, another question.
Yes, go ahead.
Please, so does it mean that? Sir, please, so does it mean that the working capital is equal to the current asset minus the liability that the business has?
So current asset minus current liabilities is current, right? That's what.
Okay.
Yeah.
So when you add all of them, you get the total assets.
So when you so this is how the format runs. First, bring your fixed assets, then go and find your working capital. Okay, so when you add the working capital to the fixed asset, then you get the net total asset. Net total asset.
Okay, sir.
So I want you to understand it like that. Bring your fixed asset, go and look for your working capital. And working capital is current assets minus current liabilities, right? Then when you get to the finance by, you look for your capital and add on long-term liabilities. Okay.
Sir.
Yes.
Sir, please, the capital, please, do you add, after getting all the capital, you get the net profit, do you add the closing, do you add the long-term liabilities to it?
Exactly. You add the
you add it together with the closing capital.
Yes.
So like closing capital, is it like the amount of money that you get after like the business, like you are done with operation for the year?
Yeah. So if you look at it, the closing capital is how much you started initially. So that's this one. So this one is actually opening capital. Okay. But in the balance sheet, we normally don't show this opening. But for your understanding, let me put it there. So you begin with your opening capital. How much did you start with? Okay. And then you add on any additional capital. So maybe within the course of doing business, you bring in more capital. That's the additional capital. So you add it. And then you less drawings. Have you taken anything out for personal use? You less that one. And then you add your profit or loss. The profit you are making for running the business, you add it. You see, that is why our mummies or our traders who have been running businesses, when they get profit, they say that, my business is booming, my capital is increasing. But when they start making losses, they say, oh, my capital is what? It's getting to zero. Normally, they use these terms. Me is capital. So when they say it means they are making losses. And the more you make losses, your capital will reduce. Likewise, if you make more profits, your capital will increase, right? Okay. So that is it. Yeah.
That's another question.
Oh, go ahead. In fact, as many questions you can ask, I am available to answer you.
Okay, sir. So please, the net profit, please. Is it the one that you get after adding all the opening and then the additional owner and subtracting it from the drawings?
No, this net profit is what you determined in your profit and loss account. Have you forgotten it?
No, sir. So
So
please, after that one, that's how you get the closing capital.
yes. So you see,
Then you subtract it.
this closing capital is the opening capital plus, okay, maybe I should do the add and less so that you can get it well. So you add additional capital, you less drawings, you add net profit, then that will give you the closing capital. And then you add the long-term liabilities to
Okay,
get the
sir.
capital
Thank you.
employed. Yeah. Amuzu, Ben, Mauli, Christabel, Fifi, Hillary, Nicole, Stacy. Don't you have questions?
No.
Okay, that's fine. That's good to know. Okay, so now let's look at the broad balance sheet. So again, we will start with our fixed assets, right? So we are just developing this skeleton here. So try and link it. So fixed assets. But this time, we will list some of the fixed assets. So professors, can you give me examples of the fixed assets you know? Fixed assets. Any fixed asset you know? Yes, Gabriel.
Sir, please, furniture.
Yes, furniture is one of them. Thank you. Yes, what else? Professors, you know now, mention. Let me call. Prof. Christabel. Any fixed asset you know? Yes. Okay. Nicole, let me hear you.
Sir, please, land and building.
Land and building. Okay, great. Amuzu.
Surplus machines.
Yes, machines, plant and machines. Christabel, are you available now to give us one? I think Gabriel mentioned furniture.
Please, like, what are we mentioning? I got off my seat for a while.
Okay, so we are looking at fixed assets. So we've mentioned furniture, land and building, plant and machinery. Can you add on?
Vehicles.
Exactly, vehicles, motor vehicles. So you see, the question will give you these assets, right, in the trial balance. So you go and pick them. So you see, the skeleton I gave here was grouping them as fixed assets, right? But in the balance sheet, you have to show them one after the other, depending on what the question I've given you. It is important for you to show the tangibles first, like you have mentioned, land and building. You have plant and machine or machinery. We have motor vehicles. We have furniture and fittings. Then, of course, don't forget your intangibles, which can be goodwill or copyright. But if you really check the past questions, hardly do you see some of these intangibles. But remember, they are also part of your fixed assets. Now, listen. In our balance sheet, when we are presenting the fixed assets, we normally show the cost, how much cost we incurred in acquiring that asset. Then we also show what we call accumulated depreciation. Okay, but you can shorten it as this, ACCDEP. But I'm saying it is accumulated. Okay, and then finally, the net book value, which is NBV. Net book value. So note these things I'm mentioning, and I'll explain them shortly. Okay, so we all know the cost, right? The cost of an asset is actually all the costs we incurred to get the asset ready for use, right? It's normally given in the question. Now, accumulated depreciation, what is this? You see, assets, okay, especially the tangible ones, fixed assets, the tangible ones, they depreciate. When we say they depreciate, it means that their value falls or they lose value over usage or over time, or sometimes technology can affect their values. If you buy a vehicle today, trust me, in the next year or even in the next month, as you continue to use it, you see that some of the parts will be rusting, will be wearing, tearing off. So it will depreciate. Now, there is a way we can measure this depreciation. There are several methods for measuring, and I think when you start the adjustment, some of these things will become clearer to you. But I just want you to understand. Okay, so when you bring the cost, this accumulated depreciation refers to how much the assets has reduced in value. Okay, so you normally subtract this accumulated depreciation from the cost, and the result you get is the net book value. So if you buy a phone today, for say, or let's say you bought it 2 years ago, 2024. You bought it at 1,500 cedis. You can attest to the fact that the phone has been falling down, water has been thrown, so you are seeing cracks, right? So the phone is depreciating. If you measure that depreciation and you subtract it from the cost, what you get is the net book value, or sometimes referred to as the carrying amount. The carrying amount. Okay, so in the balance sheet we show this, but it will become more important when adjustment come in, because depreciation is one of the adjustments you have to make. So you normally show them your plant and machine. Okay, you show how much has been depreciated and then the net book value. Now, let me say that for the land and building, the only asset that is depreciated here is the building, not the land. In accounting, we don't depreciate land because land appreciates in the eyes of the accountant. Okay. So if you see any depreciation on land and building, it is only referring to the land component, right? And then the intangible assets, they don't depreciate. We amortize them. Okay, they also their values also fall. If you have goodwill, it doesn't stay forever. Imagine key soap. Do you know key soap? How many of you know key soap? I doubt if you people know key soap. But key soap used to be very popular. Goodwill is actually popularity because the product is of quality, or the business is having a greater market share, etc. Right? Key soap used to be the soap of the day for bathing, for washing, for everything. But currently, that goodwill is gone, right? So normally we amortize goodwill as well, but at your level, you don't do much of those things. So in your further studies or in your advanced studies, you come across amortization and impairment analysis, etc. Okay. So when you list all your fixed assets, look at it. You total them here. So the third column, then we'll have your total fixed assets. Let me put that in red ink. Okay. So after getting your total fixed assets, you now show the current assets. So we are following the skeleton again. So the current assets, you put them at the middle column, right? Now, professors, what are the current assets you know? This one too, let's list them together. Current asset, yes. Yes, Christabel.
Inventory.
Inventory, very good. Inventory, or what you know to be the stock. So stock or inventory. Normally it is the closing stock, right? You show in your balance sheet, so pay attention to. Apart from the stock, what else? Yes, Nicole.
Sir, please, debtors.
Debtors, your debtors or receivables. Your debtors or receivables. What next? Okay, let me introduce some two things that you might be wondering, how are these things assets? So we have what we call prepaid expense. Prepaid expenses. Okay, and what is prepaid expense? It's just an expense you have, you have not incurred, but you have made payment for it. Example, you have paid a landlord for 3 years, but you have actually stayed in the room for a year. So you see that the 2 years you haven't stayed in the room, right? And it's probable that you'll be staying in that room until then. That prepaid amount is your current asset. It does not belong to the landlord, right? So prepaid expenses are current assets. Then we have income accrued. Sometimes you have earned an income, but you have not received it. Okay, or there's enough evidence that you receive it the next year. So in this year, you show it as what? Income accrued. These two will make sense to you when you start the adjustment. So for now, let me just put them in. We may not come across it when we start solving examples under the balance sheet without adjustment, right? The depreciation will not come in. This prepaid expense and income accrual will not come in, but you need to know that they are part of your current assets. Then finally, we have your cash at bank and then your cash in hand. So these, professors, are your current assets. Your stock, your debtors, your prepaid expenses, your income accrued, your bank, and then your cash. So that will give you your total current assets. I want you to put the total just under it. Then let's go to our skeleton. From your current asset, what do? You less current liabilities so that you can get the working capital. So you go and also say less your current liabilities. And again here, professors, you are going to help me list the current liabilities. So what are the current liabilities you know? Oh, have we forgotten our current liabilities? Okay. The first and common one is your creditors or payables. So creditors are also known as payables, in case you see that in your question. Then we have bank overdrafts. Bank overdrafts. Yes, Fifi.
Please, expenses owing.
Good. Expenses accrued. And you see, accrual is the same as owing. So you see, this one, it means that you have incurred the expense, but you haven't paid. Like you have taken the room of the landlord, but you haven't made any payment for the rent. It means you are owing, and all owings are what? Liabilities. So expenses accrual or expenses accrued is the opposite of prepaid expense, right? Expense accrued. Good. So that one will come here. And then the income accrued here would be income received in advance, or income prepaid. Let me explain this one too. You are a business. People have given you money, but you have not performed the service or you have not given them any product. Technically, what you have received is not your money. Okay, it's like in school, you take 10 cedis from your friend that you copy notes for her. If you haven't copied the note, the 10 cedis is technically not yours, right? So when you receive any money you have not performed or rendered any service for or provided anything for, it is a liability. The person can say, you is okay, don't go and don't copy the notes, give me my money, right? So these are your current liabilities, right? So that one, you add them. So you see that I put that one at the first column, right? So I add them and they are total. So the total current liabilities will now come under the total current assets, you see, because we are coming to less it from it. And when we less it from it, we'll get the working capital. The working capital. And the working capital will now come under the total fixed assets, right, to be added on. So let me highlight that one too. It looks plenty here, but if you understand, it should be easier for you. So you see now we have our total fixed asset and our working capital. In the skeleton, you just see it as simple as this, right? You see it as simple as this, fixed asset, and then you go and less current liabilities from current asset to get the working capital add. Here we are just putting in the specific assets and liabilities. That's why it has become too long like that. Okay. So when we add the two, then we get the net total assets. Let me use DTT to represent that. The net total assets. Then you can say you are done with the first section of the balance sheet. Let me use a green. Okay, so that's our net total assets. Okay, then you are left with the final bit, which is the financed by. Okay, the financed by. As for the financed by, technically it is what it is as it is shown in the skeleton. Okay, so financed by, you put your capital here, you add the additional capital, you less drawings, or you subtract, you add net profit. So actually, some students prefer to do all the addition before they less, but it doesn't matter how you want to present it in that case. Right. So then this will give you the closing capital. Then long-term liabilities, let me be specific here. For the sole trader, the long-term liability you are going to see is loan. So normally we put the heading long-term liability and show this loan. Sometimes you see bank loan, but any loan is a loan. So loan. So that's what you add on, and then you get the capital employed. And as I said, the capital employed should always be equal to the net total assets, right? So that's what I've shown here. So this is it. So you see, under the finance by section, it's not really much. It's just your capital, and some of the questions you might not even have opening additional capital. So you just bring your capital, less drawings, add net profit, then you add the long-term liability, right? And that'll be all for your balance sheet. Professor, it looks a bit lengthy, and you might feel that, hey, how can I remember all these? But you see, it comes with practice. The more you practice, the more it gets to your fingertips. So I tell my professors, when you are learning, don't rush through it. You can only decide to today focus on only your fixed assets, right? Then in the next, or at the next time, you look at how you present your current assets and your current liabilities. Okay, how you get the working capital. You just learn that one. That okay, you bring your current assets total, bring your current liabilities total, you subtract and get the working capital. So learn them in blocks. Don't try to remember everything a day. It's not possible. Well, it's possible for some people, but learning in bits, small, is better than when you lump all of them together and you are worrying your brain, okay? So we can learn the formats gradually. And when you are good to go, you start solving illustrations, right? Okay, so I'll pause for questions before we continue. Any question, professors? No questions? Okay, have we copied this format? Have we done that?
Please, no.
Okay, so let me leave it on the screen for you to copy. Then we can continue. So I guess we would have to take time and practice this over and over so that we can remember and grasp it. So that when we are solving an illustration, it will be easier for us. Okay. So professors, I'm begging you, okay, take your time. I will share the video. So if you miss the point, watch it, take your time. Trust me, this thing is going to haunt you for the rest of your life, because in the university, you'll be preparing balance sheet, you'll be preparing these things, right? So learn them now, understand, and get them once and for all. And from experience, the only sure way to getting this is practice. If you don't practice it, if you don't solve more questions, trust me, you feel like accounting is difficult, but it's not difficult at all. Okay, so please try and practice it over and over and over. Okay, so you can have this format on one side. You look at it, you cover, you try to rewrite it. Okay, when you do 1, 2, 3, you would know that, okay, it's coming gradually. So I think I'll pause here for questions. If there are no questions, I'll leave the rest of the time to you to go through the format. And if possible, I'll put a question on the page, but we'll solve the question together. But those who can attempt or would want to try, can try. I think it will start from the trading, profit and loss, then end with the balance sheet. Okay. So profs, any issue? So I think because of the time, and I would have to quickly upload this video on your platform so that you can have access, right? Okay. So thank you very much, professors, for making it up. Even though we are having light power outages, you try to make up for class. I'm grateful. So I'll quickly share this video so that you can watch it, go over the format, practice it, and then hopefully next week, Monday, when we meet, we can solve an illustration. And you take your tests on Friday, okay, to conclude the class. Then I'm sure when you go to school, when you start this topic, or when you would appreciate our discussions better. Okay, so thank you very much, professors. Do have a great day. I'll see you when I see you.